Hello, this module will go over Chapter 4 from the Zelman book, Financial Statement Analysis. Now we're switching from accounting, journal entries and so forth, to looking at financial statements and interpreting them. So there are different types of analysis that we're going to look at: horizontal, trend, vertical, and ratio. In horizontal analysis, we are looking at one year to another year. So in our financial statements, you always see 2 years. So if it's a balance sheet, you see for the fiscal year end 9/30/2016 and 9/30/2015. And for a trend, we look at from a year to a bunch of years. So you may want to look at your revenue for the last 8 years. And we look at this by calculating the dollar difference as well as the percentage. So here's an example. From 2002 to 2003, revenue increased by $212 or 2% change. Meanwhile, our expenses increased by $916 or 9.4% change. So as we're looking at horizontal and other analysis, we want to be thinking, what is the story that we're hearing about? Here's an example of vertical analysis. So horizontal obviously is across, and vertical is up and down. So here, of our total assets, cash is 4.6% in 2003, and that compares to last year where it was 4.9% of our total. So that's vertical and horizontal analysis. Now we're going to shift to ratios. So ratios are a comparison of two numbers, and we like to compare those to a benchmark, and that's what makes them meaningful. Examples of ratio analysis, or the major categories, are liquidity, which tells us if we're able to meet our short-term obligations; profitability, so was the organization profitable; capital structure or solvency is if you went to get additional loans or issue new debt, how well would you be able to do that, or how leveraged are you? And then activity, which tells us how efficiently are we using our assets and our net assets. So I want to go over an example of ratios and how we look at them and interpret them. So in this example, at the top we have our current ratio, right? A current ratio is current assets divided by current liabilities. Now you don't need to memorize the ratios because in your book there is the formulas, and those are the formulas we will use. So in this example, our current ratio went from 1.98, it increased to 2.10. So what does that tell us? Well, by itself it just tells us that it changed and it increased. So what we want to understand is, how do we want the ratio to be? Do we want it to be increasing or decreasing? So in this case, where it says trend, we want it's trending favorably because it's increasing. And the current ratio, we want it to be higher. So if we're going to compare it to a benchmark, in this example the benchmark is 2.18. So if I were to describe this organization and their current ratio results, I would say in the year 2002 and in 2003, this organization is unfavorable to the benchmark because the benchmark is 2.18. However, they are trending favorably because they went from 1.98 to 2.10. Now if this was the only information I knew about this organization, the only thing I could say is they may have some difficulty paying off their current liabilities. Another very important ratio that we look at or calculation is days in accounts receivable, or days in AR. So what is days in AR? It tells us how long does it take the organization to convert its receivables to cash. So here the benchmark that we're using is 67 days. And so we want to know, how are they to the benchmark? So here's the results in 2002. So would you want your receivables to be paid in 77 days or 67 days? Well, you would want them be paid sooner. So in this case, they are unfavorable. And because in the next year, 2003, they're at 88 days, they are trending unfavorably. So this organization, we would say, could have a cash flow problem because they're taking a long time to get their receivables paid. Now in the final one, days cash on hand, what does that tell us? It tells us how many days they can pay their expenses without taking in any additional revenue. So the benchmark in this case is 46. And so in year 2002, they had 44 days cash on hand. Now would you want to have more cash on hand or less cash on hand? So I hope you're saying you want to have more cash on hand. So in year 2002, they were unfavorable to the standard or to the benchmark. However, they increased their days cash on hand to 50 in 2003, and therefore they are now favorable to the benchmark, and they're trending favorably as well, because the trend went from 44 to 50. So those were some of the major ratios that I look at, and those all fall under liquidity. So liquidity ratios tend to look at how fast we can convert things to cash. So the current ratio, is the first one we discussed, is the main one that I would say you should focus on. The quick ratio and the acid test are similar to the current, but they exclude some components of current assets. Days in AR, the calculation is your net accounts receivable divided by the result of taking your net patient service revenue divided by 365. So you may remember from your school days PEMDAS, P-E-M-D-A-S. So first we do parentheses, we do exponents, multiplication, division, addition, subtraction. Right, so we would do this first, and then we would take this, divided by that. Days cash on hand we talked about, so that is cash plus marketable securities divided by average daily cash expenses. One of the important things to remember for days cash on hand as you're looking at your own financial statements that you will review, included in days cash on hand are what we call board designated funds. So board designated funds are assets that the non-for-profit institution has that they are just setting aside for no particular purpose. They call them board designated funds. They are not restricted in any way, and so they should be added in to your calculation to do days cash on hand. So average daily cash expenses, we'll go over that calculation in a little bit as well. Average payment period, you can see here. So the next section is profitability ratios. We will always look at the operating margin, which is operating income divided by total operating revenue. We want to know what is our margin to the benchmark. And these other ones are also important, and we'll go over those in class. Capital structure tells us how our debt is to our assets, and you can see some of those here. And activity ratios, the main one that we will look at is our age of plant, accumulated depreciation divided by depreciation expense. This tells us how old our equipment and our buildings and so forth are. And if you think about it, especially in healthcare, do you want old stuff or new stuff? Well, if I was going to get an MRI, I probably would want the greatest, right, versus an old ancient one. So just some key points to wrap up this chapter, that when you are comparing ratios from one entity to another, sometimes people use different definitions of the ratio, so you have to make sure you're comparing apples to apples. When you're selecting a benchmark, you always want to look at the past year or budget, so forth. And you want to look at what is the benchmark, how are you doing to the benchmark, and how are you trending to the benchmark. Finally, there's no one key ratio that tells you a story, but they tell you a clue. And so as you look at each one, you hopefully can glean a story or would give you questions that you would want to ask. So for example, if our operating margin was low, right, and we wanted to improve that, operating margin is our operating income divided by total operating revenue. One way we could do that is to increase our operating income, right? So our operating income is our revenue less expenses, so we could do that by lowering our expenses or increasing our operating income. Total operating revenue, that's our revenue. So if we had less revenue but our income went up, that would also increase the margin. Under the current ratio, if we had greater current assets, that would increase the ratio, or lower current liabilities, that would increase the ratio. And so again, the ones that we want to focus on are our current ratio, which is a liquidity ratio, which tells us how well the organization is positioned to meet its short-term obligations. Our profitability ratios tell us how profitable is the organization. Activity ratios tell us how efficiently we're using our assets to produce revenues. And capital structure talks about our debt. And we interpret results by benchmarking. This is a good summary from your book that gives you the desired position and the trend position that you want. There's a few others that I will hand out in class. So in summary, no one ratio is better than another. Each answers a question. You want to use them against benchmarks which are appropriate, similar, and reliable.